Hello everyone and welcome back. This is a very important series of conversations that we're going to have, and we're going to focus on secondaries. Why are secondaries so popular right now? And for sure they are. As you can see, we've had everyone in the private equity and venture capital universe discuss secondaries. VC secondaries are still small, but we've had very large European secondary funds raised. So surely all of you are wondering, what is this thing called secondaries? Yale decided to sell $6 billion of its private equity portfolio out of its endowment fund. At least that deal is right now being discussed. We will see how much actually happens. So let's dive in. Let's figure out what a secondaries is. So number one, secondaries clearly have been set up to add liquidity to an illiquid asset class. Those of you that have been with me on the channel for the last 5 years, you will realize that private equity naturally is an illiquid asset class. The PE secondary market is quasi the resale market for investor interests in funds and direct investments. So that means secondary transactions are one way for investors, the LPs in private equity funds, to exit early from their investments without waiting until the fund has played out. With the market growing, with the primary market growing in line with the secondary market, of course, this is becoming really quite interesting right now. It helps investors rebalance their portfolio, decide, for example, to move out of American buyouts and buy more European growth equity, for example, without having to wait till the fund has achieved its 10-year lifespan. As you can see in the left-hand slide, we have seen with primary market private equity funds growing, secondary markets really starting to ramp up. So let's take a bit of a closer look and dive in. What you can see here is the rapid growth just since 2015 of the secondary market. And what you can here see as well is that originally secondaries were very much focused on the need of LPs to get liquidity. So we saw the blue bars that you see here, LP-led secondaries drive the force. Now that has changed or is about to change. As we're going into 2024, 2025, we see that GP-led strategies in the secondary space are taking over. And don't worry, we will look into each of those strategies in part 2 and 3 of this series. But as you can see also, the forecast that we're seeing here for the size of the secondary market is quite ambitious by 2030. That's not that far away. So what do secondary funds or secondary investors actually do? What's the benefit for those LPs out there? Let me fly in the 2 bars. Between those bars is the typical acquisition line for secondary funds. What does that mean? That's where secondary funds like to play. And as you can see already, what you're looking at obviously is our famous J-curve, the usual liquidity profile or the liquidity, the drawdown that you see from year 1 to year 10 as an LP in a primary private equity fund. Now, secondary players come in after that dip in the J-curve. That means obviously that their path to liquidity is significantly faster. And we'll come back to that again. But that gives you already maybe a flavor on why secondaries are really quite attractive right now. So the attractions of secondary fund investors are the following. So number one, a really attractive risk-weighted return profile, faster access to liquidity. That means a mitigation of the J-curve. Unrivaled diversification. Secondary funds are typically really diversified across different GPs. So even investing in 1 or 2 secondary funds gives you an interesting exposure to the private capital space. And then invaluable market insights. So if you're planning on joining a secondary funds are in good relationships with both the GPs as well as the LPs. So I usually say that if I'm trying to establish whether a certain topic deserves more attention in terms of research, I usually make calls to secondary funds. And of course, all of you have been wondering, at what price do those secondary transactions actually take place? And what to expect going forward when we look at history. So here's a graph that shows the last 22 years of secondary pricing. As you can see, there are times when, even on average, stakes in the secondary space are trading at a premium, but most of the time, they change hands at a discount. And a discount of about 14% has been the average over the last 2 decades. Thank you very much for joining me. This was part 1 on my lecture series on secondaries. In part 2, we're going to start diving deeper into LP-leds and GP-led transactions. Thanks very much.